It's the weekend and you have financial questions that need answering. That can only mean one thing. It's time for Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome to the Jill on Money Show. This is the program that takes the mystery out of your financial life. I am your host, Jill Schlesinger. Mark Talercio is the best executive producer in the world, and he is running the program. This show is about you. This is about what's going on in your financial life. So if you have a financial concern, a question, an issue, something that is maybe keeping you up at night, maybe it's just something that you want clarified, we are here for you. All you need to do is go to our website, jillonmoney.com, click the Contact Us button, and when you do, a form will pop up. Just complete the form, and then if you want to come on the air with us live, just check that little box. It's very easy to do. Mark does everything else from there. Okay, so let's start the program with one of you. This is Sam, who's on the line from Texas. What's going on? How can we help you out?
All is well. Thank you guys for having me. I'm 29 years old. I live out in Houston, Texas. I'm a little confused and a sort of a dilemma and just would love some insight from you guys. I was fortunate to play collegiate sports, so I have a bachelor's degree, but I don't have any debt.
Yes. Wait, what was your sport?
Football.
Nice. Okay.
So I don't have any student loans or anything alike. I actually don't have any debt at all, minus a home that I purchased a year ago, and the rate was a 3.3, so I got in at the perfect time.
How much did you pay for the house?
I paid $230. I owe $217.
Okay. And it's at 3.3%, 30-year fixed?
Yes.
Fantastic. You're so young to have a house. Are you married? Are you single? Are you partnered? What's going on?
So I'm engaged. I'm getting married later this year.
Congratulations. How old is your betrothed to be?
She's 29 years old.
Okay.
We're both 29.
Okay. So you got this house. You own this house. Fantastic. You're so young. You guys are both working?
Yes. So I have a fitness company, so I bring in anywhere between 90 to 120 a year.
Woo!
He brings in, I'll say, about 65 or so as a teacher.
You're marrying somebody with A, health benefits, and B, a pension. You're the best person ever. I mean, that's fantastic. Yeah. I think about these things. So, Sam, you are self-employed?
Yes.
Okay. Right now, how do you get your health insurance? Do you get it? You can't get it through your fiance yet, but do you pay for it?
Yeah, I pay for it. It's about $230 per month. I did downgrade the plan just because I know the wedding is coming up. So for this year, I did downgrade and get something a little more inexpensive just to cover the basics, because again, the wedding is in about 6 to 8 months now. So just kind of if an emergency or something came up, I would be fine.
Okay. Are you guys paying for this wedding yourselves?
Yes. So her parent has helped out. My grandmother has helped out. We're 98% done paying for the wedding. We've been saving up for it. I knew that I wanted to marry her, so I was saving up quietly. So we won't carry any debt at all for the wedding. So the wedding will be paid for in the next 10 days.
Fantastic. Okay. How much does your wedding in Houston, Texas cost? Mark's wedding was very cheap. By the way, I was not invited. I was invited and then disinvited to Mark's wedding, just to be clear.
$25 for me.
$25 for, no, what was dinner?
Oh, dinner. Yeah, that's right. But the marriage process itself was $25.
Okay. How about Sam? Is yours a little bit more than $25?
Yeah, so it's roughly around $17,000, and we're actually getting married in our hometown back in Florida.
But you're staying in Houston. You got your business. She's a teacher. Life is good. Now, you are self-employed. Do you have your own retirement plan, or have you not done that yet?
Yes, so I have a retirement plan. I have both the traditional and the Roth IRA. I max out on the traditional every year, and I put additional. So I put $6,000 every year into the traditional. Put about another 3 to 4 a year into the Roth. So overall, with my total portfolio, I have about 35 to 40K in just stocks overall.
What was that? Oh, Mark, what are you saying?
You can only max out a traditional or a Roth. You can't do both.
No, I only max out the traditional. I put money in the Roth, but I don't max out.
Yeah, but you can only do $6,000 a year or $6,500 combined.
I don't know how they let me do it. I don't know how.
Okay, so stop doing that.
Okay.
Stop doing that. Don't put money in your traditional. Just stop doing money in the traditional. Just do the Roth and that's it. Unless you're telling me you don't have a SEP IRA, do you?
No.
Okay.
That's something my accountant and I did speak about, is possibly establishing a SEP account.
Okay. Stop putting money into the traditional.
Keep your records handy in case somebody flags that down the road, because you can only do 6,000 total. You can do 3,000 in a traditional and 3,000 in a Roth, but you cannot exceed 6,000 between IRAs.
Yeah, although it's 6,500 for this year, so that's a bunch of money. So let's do that, okay? And do keep good records. Okay, now your fiance, does she also contribute to a retirement account, or is she just doing the pension? Where is she?
She has the 401k at her school. She didn't know much about it until a few years back when we started dating, and she was at a different point in her life at the time where she didn't have much disposable money. She was in a different school district. Just started doing it. I think it may be like $100 to $200 a month. So she's more. Okay. We're both at the infancy stage, but she's kind of newer. Started.
That's
out.
Great. So when you said 35 to 40 grand, that's like in your retirement accounts. And do you have non-retirement also?
Yeah, I have non-retirement also. So I have just a brokerage account there. Index funds. I did get a couple different stocks here and there when certain splits occurred. Like I had some Google, some Amazon.
So what brings you to us today? Like, this is all good news mostly, except for your silly brokerage account, but fine. What is it that you think is like the pressing issue that you see?
So the pressing issue I have is that like most of my shoes would want to open some sort of gym or fitness facility.
Yeah.
For me, I care more. And I would say, being a former athlete, I know the behind the scenes, a lot of things that go on with athletics. And I think although I love fitness, I do want to have kids over the next few years. I just don't want them. I want them to have the flexibility where if they're not interested in athletics, then they don't have to do that. So I've kind of been learning more about real estate. I think that's something I want to dive deeper into and just have something to, when we talk about generational wealth, and something to pass on to my kids where they have the flexibility where even if they want to use it to start their own business or to pay for school or whatever the case may be, they have that flexibility. Because I see I never met a gym owner that's retired. I never met one. A lot of people get upset when I say that, but when you think about it, no one can ever name one gym owner that retired.
But you like what you do now, or you're like, I'm done with it?
I like it, but I think for me, so I've trained a ton of like professional athletes. I've been endorsed by Nike. I've trained in the US and Canada. I've traveled the world doing it. So I kind of think that I'm kind of at that point where it's kind of getting redundant. I don't know, like I enjoy it, but it's also like as I'm getting older and going into this next chapter in my life, I just want to make sure that for one, I want to be more present at the moments that matter most. So I have a number of athletes, they train with me several times a week. They're youth athletes, and they have a lot of vulnerable conversations with me, and they share how they just wish, their parents think that money is everything. They buy them things. They're like, I just want my dad to play catch, but he's talking about what car he's going to buy me next month.
Yeah.
Just different things like that. So I just want to have you
want to transition into something else. So I got that. I get that. We'll get back to Sam in just a minute. Now, in the break time, why not go to our website, JillOnMoney.com. There, you're going to see all sorts of content. You can subscribe to our free weekly newsletter, and you can be part of our brand new service. It's called Jill on Money Live. For $35, you can join us for 4 webinars annually. We'll be right back.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
You're back. It's Jill on Money. And if you would like a little bit more of Jill on Money, all you need to do is bookmark our website. It's JillOnMoney.com. Right there on that website, there is so much great stuff. There are links to our 2 podcasts. One is called Jill on Money, the podcast. The other is called Money Watch. You can check those out. We also have a blog. I try to keep you updated with different things going on. It can be more personal finance. It could be more newsy. I try to write about the things that I find interesting, and sometimes writing is a way for me to process the more complicated stuff and the newsy stuff. So I hope you enjoy that. Check it out. It's right there on the blog. All right, now let's get back to Sam from Texas. We're talking about some possible next moves. Is the idea here that you would want to slowly dip your toe into becoming a real estate agent, or that you would like to dip your toe into being a landlord?
More the landlord. I'm not interested in the agent part. I think I would still be doing the same thing a different way.
Uh-huh.
So I think it's more about being a landlord, and just also, I just wonder when my kids get older, they don't, like, I grew up very rough and I didn't have a lot of flexibility with things. I just think about, even when I graduated from college, there was a lot of other things that I wanted to do. But when you're in a family that doesn't have disposable income and they need everyone to contribute to keep the lights on, it's kind of like you're forced to do what you have to do.
Yep.
Instead of having the flexibility of, why couldn't I do a 6-month internship somewhere that I wouldn't get paid at all, but the experience would help
Get you to a different place. Yeah.
So just different things like that I just want to.
Yeah. I mean, look, I think that there's, first of all, it's quite admirable that you're thinking that way for your as of yet not to be conceived child or children. But what I think you're raising is that you want to be able to accumulate enough assets, whether call it a house or a brokerage account or something, enough assets to be able to live a life that is a little less stress filled than the one that you had to grow up in. And I think you're doing that already. So that's number one. You're already you're so well ahead of the game. I'm sure that Mark will want to give you a kudos for this. But you're putting money away. You've got the money going. How much money do you have in cash right now?
You're going to kill me if I told you.
No, I don't have to kill you. I like you.
So across all of my accounts, I probably, and this is not counting the stocks and stuff, you're talking anywhere between 95 to 110,000.
I'm not going to kill you. I like cash. It's one of my favorite asset classes. I think that there's a few things to consider. One is that to just create a destiny that it's just like, I'm going to buy houses and flip them and that's fine, but it takes work. And it would mean that you really have to start investigating how to do that. I wouldn't want you to burn up all that cash, especially in this current environment. It's not a great environment to become a real estate maven because interest rates are higher now and it's a little bit tough and there's not a lot of inventory. But if you're interested in it, I would start talking to people who do it and try to get some information and learn about it, educate yourself. That said, I mean, you may find that you have, you've got a business, it's thriving, you're young. While it's still thriving and you're young, you put as much money away as you can. And I would start thinking about, if this is not the job that I actually want, what is the job that I want? That requires you to do more work, right? And I don't think that just like buying real estate and having passive income is a job. It sounds to me like you're a very hardworking man, that you want to feel good about what you're doing, that maybe the training thing was an amazing idea. Maybe it was a great way for you to enter into sort of your adult life. Then you leverage the thing that you knew how to do. Maybe you want something different. And that means that you have to really start thinking about it. So what I would do is I would kind of start pretending that you're like graduating again. And when you graduated, you didn't have choices, but now you do. And I would go back into, say, my college resources. I'd start finding other people who played football at your college. I'd start getting in touch and saying, what are these people doing? Is there something here that's interesting? Honestly, Sam, just talking to you and hearing you tell your, I think you'd be an amazing financial planner. If you like a little math on the side, you have those kinds of qualities. You seem to be a caring person, but you care about, you understand how financial stability can really give you many more opportunities in the future. And maybe there's someone in your world and in your network who does something cool that you think is great. Maybe it's that you say, you know what? It was great to own my own business, but really my fiance seems really happy. Maybe I would like to teach, or maybe I'd like to coach, or maybe I wouldn't want to do that. Maybe I want to do something totally different. I think you're on the beginning of your journey and you've got some work to do. I would start by thinking about what are the things that kind of jazz me? What are the things I didn't get to do? Because you got $100,000 in the bank right now, and that can finance a transition. And it doesn't mean you give up what you're doing immediately, but if you say like, by the time I'm married a couple of years, I want to have a different path. And maybe you do a lot of research and you're like, actually, my path that I'm on is really great. I just have to do it differently. I don't know. I think that what you really need to be considering is how do you want to contribute to the Sam and fiance life in a way that makes you feel good, but it's not going to be easy. And you got some work to do. What do you think about that?
I think it's a great idea. I think everything you said is spot on, and it's definitely giving me some things to think about. You haven't said anything that I disagree with at all.
Thank goodness. We'll get there. Here's how I relate to you, Sam. Of course, I have the exact opposite story. Like, I'm a girl who grew up with privilege and college was paid for, but my dad was a trader on the floor of the American Stock Exchange. And so there was a pathway for me that I saw, like, oh, I go be a trader. I do this, I do that. And like 3-4 years into it, I was kind of like, I don't know. Like, this is not doing it for me. And it was really hard because, I'm sure that you realize like you are in this, like you even said it in your email, like I've been fortunate. I got to travel the world. You've said it here. Like I've been doing like cool stuff. Right. But it's also okay to say like, but it's not feeding me, emotionally. It's great financially, but it's not like doing what I thought it was going to do, or maybe, but it brings you to this position where you can ask yourself, what is it that I want to do? So when I was in that transition phase, I just started talking to a lot of people and I did some wacky things. Okay. And so this is the kind of thing that like you try, especially while you still have you have the flow of income. You could like reduce, you don't have to work you have to kill yourself. Instead, you might say, well, in this transition phase, instead of making 120 a year, I'd rather make 90 and start exploring these other things. And you give yourself permission to do that. And that to me is something that's really worth considering. I think, look around you. Remember that this idea, I know a lot of us fall into this trap where it's like, I'll just buy real estate and that will be, the be all end all and I'll make that work. But that's not necessarily a career. That could be a side hustle for you, but I don't know if that's necessarily a career. And it's a heck of a lot of work, meaning that like to do it well usually means you're doing the work yourself. You just have to like tend to it. So I think it's time for you to pick your head up. Like, you're getting married. This is great. So you're going to get married. But even in the run up to getting married, it's fine to have extra cash. I would be cash heavy right now if I were you, because in times of transition, I think having that cash cushion is really smart, even if you are 29. So here's your marching orders. You ready, Sam? Number 1, you're going to keep your cash on hand. Number 2, you're going to only contribute to your Roth IRA $6,500 this year. Number 3, you're going to give yourself a little bit of a homework assignment, which is I'm going to start thinking about all the people I know who I think do cool things. And I'm just going to start talking to them. And it could even be clients of yours. I had a trainer in New York City and he had such fascinating clients. And one of his clients hired him essentially and said like, I'm opening up a hotel. Would you be interested in helping me like basically conceive of how a gym should look? And it was just kind of like a fun job to do for a while. It was great, And so there are things that might be out there that could use your skills, some that would be totally different, but think big. All right. Well, if you would like to come on the air like Sam, all you need to do is go to the website, JillOnMoney.com, click the Contact Us button. Hey, while you're there, why not buy my book? It's called The Great Money Reset, and it's based on a lot of the conversations I've had here on this program with you. You'll find 10 bold steps to turn chaos into opportunity. The Great Money Reset. Jill on Money. We'll be right back.
Back to Jill on Money, where Jill Schlesinger helps you take the mystery out of your finances.
You're back. It's Jill on Money, the program that attempts to take the mystery out of your financial life. And the way that we do that is we make you do just a little bit of work. What does that work entail? It entails you going to our website, JillOnMoney.com. Then you click the Contact Us button. After that, Mark does everything else. That's how good he is. Now, the questions that you guys have been asking a lot lately may have to do with the tax season, which is really right upon us now, a couple weeks away, 3 weeks away. And if you've got more significant questions about your tax situation, you may want to subscribe to our brand new service. It's called Jill on Money Live. And this will provide you with access to quarterly live webinars and more special content. The reason why I mention it along with your taxes is that our first webinar will be on March 30th. And if you want to join us for a special evening with Ed Slott, IRA expert and CPA Ed Slott, you have to subscribe to this new service, Jill on Money Live. So go to the website, jillonmoney.com, and check out this new service. And please do join us on March 30th. It will be an amazing evening. $35, 4 webinars for a whole year. It's a bargain. All right. Okay, let's talk to Karen, who is on the line from Chicago. Hello, Karen. How are you?
I'm great. How are you?
Fantastic. What's going on? How can we help you out?
So I feel like I have a financial advisor and I do pretty well in watching my money. But the one question I had was around an annuity that I purchased based on a family member suggestion back in 2017. And, our financial circumstances have changed. They're more positive. And I just questioned myself after hearing, the expenses of an annuity. Is that something I should keep, get rid of? What should I do? And especially now that the market's down, can I pull the money out and invest it?
Well, right. I know it's sort of like you're looking at this opportunistically, which is kind of fabulous. It's sort of the flip side, which is, well, if the market's down, maybe I can get that money to work. Couple of questions about the annuity itself, and then I'm going to ask you questions about you. Okay. So the annuity, was the source of the funds retirement funds or non-retirement funds?
Retirement funds. They were in an IRA or a 401k that I rolled.
Okay. And then so it was an IRA rollover. And how much money did you put into the annuity in 2017?
$331,000.
Wowza. Okay. Is the surrender period, do you know where you are in the surrender period? Usually that means if you give this policy up within, say, the first 6, 7, 8 years, there's a fee to get out of whack. Do you know where that stands?
Well, as I recall, it was like a diminishing fee.
Yes.
And I thought that was 10 years. I couldn't find it in any of my documentation, but I'm not sure. I would have to look for that.
Usually the way that they would work with a 10-year surrender, which is freaking long, is that it would say, okay, you put $331,000 in, you blow out of this within the first year, you get a 10% penalty. And then it goes 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. So the problem with surrendering this policy now is you'll have a fee. Like even if it's 4%, that's a big number. That's a seriously big number. So what is the value of the annuity right now?
The value is $367.
So was this an index annuity?
Yeah, fixed index. Yep.
Fixed index. Okay. I mean, the reason why it's like kind of okay, I'm not saying that since 2017, it's probably the market was up by more, right? Because you had 17, 18, 19, 20, 21, 5 awesome years, and then 1 horrible year in 22. But I hate paying these fees if we don't have to. So why don't you tell me a little bit about other stuff going on and we can see how important it would be to get rid of this annuity. So how old are you?
I am 60.
Okay. Are you single, married?
Married. My husband's 62.
Okay. And you're both still working or you're both retired?
Both still working.
How much do you guys earn together?
About 160.
And when do you think you'll retire?
3 years.
Will either of you be entitled to a pension?
No.
Have you looked at your Social Security?
Yes.
Okay. Tell me what those numbers look like for you. Social Security at husband's full retirement age.
His would be about $2,500 and mine would be probably $2,750, something like that.
Great. Okay. How much do you think you need to live on a year?
So outside, if we take out the house payment and that sort of thing, I was right now in today's dollars, like around $6,000.
How much is your house payment?
House payment is, let's see, the house payment, I pay $2,000, but probably 900 of that is taxes every month.
All right, but you still have to pay taxes when
Yeah,
you retire.
exactly. Exactly.
Okay, so it's $8,000 a month is what you
Yeah.
really need.
Yeah,
Okay.
yeah.
All right, now let's do the sources of your savings. Do you guys both put money into retirement?
Yeah, we're maxing out even with the, additional because we're over 55 or whatever.
Okay.
So, and we have about 1.5 million in that in a traditional IRA or traditional 401k. I'm sorry.
Okay, and what else do you have?
Then we have about 50,000 that it's in liquid, either cash or CDs. Yeah.
Any brokerage account?
Oh, I'm sorry. So the 1.5 million includes about 400,000 in a brokerage. Or 350 in a brokerage. Yeah.
Okay. So of the 1.5, it's really more like 1.1 in 401k and then 350 in a brokerage account?
Yes, correct.
Oh, great. Perfect. Okay, that's better. Okay. And what else do I need to know? How much is this house worth?
The house is worth probably 400,000. We owe 130, but it's at a 2% mortgage.
Oh my God.
rate.
You got to be kidding me.
Yeah.
We're going to look back on this. We're going to be like, we should have all borrowed $1 million. I'm not sure what we would have done with it, but my God. Anything else? You got grown kids, everyone okay? Like where do things stand for you guys?
Yeah, kids are grown, pretty much self-sufficient. Could need to help one, somebody with a house someday or something like that. But other than that, no. I mean, we don't have anything problematic really.
That's great. Okay. And the annuity is in your name or in your husband's name?
It's in my name, but then he's on it as a
beneficiary. We'll get back to Karen in just a minute. If you have a financial question, a concern, an annuity, a life insurance product, just give us a holler. Go to JillOnMoney.com, click the Contact Us button, and we will arrange to get you on the air.
Welcome back to Jill on Money, where Jill Schlesinger takes the mystery out of your finances.
You're back. It's Jill on Money. And if you are the kind of person that is thinking about your investments, your retirement, you're trying to make some sort of plan for the future, or maybe you've got a question that you're wrestling with right now, we would love to help you out. All you need to do is get onto our website, JillOnMoney.com, click the Contact Us button, and we will do everything else. Right now, let's get back to Karen and walk through a little financial plan. In 3 years, your husband is 65, right? And he gets Medicare. What are you going to do for health care in 3 years?
Well, even when we retire, we're still going to do something. So, one of us may get some sort of a job that has health care for me.
Could also just say like, all right, I'll work until, instead of saying, I'll work until I'm 63 and a half, then you have COBRA, and like you can make that work, right? You can finesse that. Okay.
Yeah, exactly.
So now, in the way that I would look at this, one of the things that you have in this annuity is you have consistency, right? It sucks that you have to pay so much for it, but it is there. So here's one way to think about it. This is money that's going to have to come out anyway. It's IRA money, it's pre-tax. And you're going to have a stream of income that comes out from all of your associated retirement accounts when you have to take your required minimum distributions at your age 75, right? But for now, you need money because you need to live on said money, right? We have to get you to your full retirement age. I think what you could do is again, in 3 years, what I would be looking at is creating a stream of income from this annuity. You don't renew it. You don't have to do anything. You could start taking 10% out a year because you can do that without getting any penalty, by the way. I think without any surrender. And maybe you start doing that like in a couple of years, you start taking a little bit of money out. Anything without a fee you should take out. And then come to a few years from now, you can start taking some money out. The surrender period is hopefully like, a smaller percentage. You take a little bit more money out, you pay the tax on it, and you use it to live on because you're not going to have Social Security. We kind of have to look at it in 3 years. You might say to them, like, what would happen if I annuitize this right now? And that might be something that we think is an important thing for you guys to do, because maybe when you're 63, we say, get all the money out by the time I'm 68. I'll get that money out every single year. I'll wait to claim my Social Security until I'm 70. It'll be even better. But I would talk to, who sold you this annuity? Your current financial advisor? You said a family friend, but is this a different person?
Yeah, so it was a family member that sold the annuities, and then I didn't want to buy it directly from them, mixing family and money. So anyway, I had a family or a financial advisor I was working with on my college funds. So I asked him. He didn't suggest it per se. I went after it and said, I want to do this. I had read up on him and such. Like I said, our financial situation was a lot different at the time too. So I was just nervous about that income stream. So that's how I ended up with it. If I'm paying, I think you said on your other podcast that some of these are costing 2 or 3% a year.
Yeah.
If I find that out, then a 4% hit or a 3% hit in a year, what's the difference, really?
I mean, and that's what I want to look at. I really would have to look at it, because there's that. I mean, listen, that's 2 or 3% might not be bad a year, but I mean, it might not be bad like down the line, but to pay like a 5% out right now is a lot. Okay. So what I would want to do, what I think it's worth doing, is go to your investment advisor and say, I need you to really take a hard look at this annuity. And I need you to come up with a game plan for how we should be pulling money out of it in order to maximize the income before we claim Social Security and minimize the hit on the expenses. And an advisor should help you do that. I don't think that you're in bad shape. I think you're actually in really good shape. You're going to be fine. It's just a question of how do we use that? You're right. If you had to do it all over again, we wouldn't want you to do it. On the other hand, you have it. So let's not blow it either, and probably was nice for you to feel a little bit like, oh, I have a little bit of safety last year. There was nothing wrong with that. I think you're going to be good. I think you really are. I just want you to be, I think we should be careful about it.
Okay. Very good. That's what I wanted.
Okay, great. A couple of other things. You got your estate documents done?
We do.
Great. And any old life insurance policies besides this annuity kicking around?
No, we went to term insurance years ago.
Perfect. Then you're in great shape. I'm very proud of you guys. You're doing great. Hey, these annuities they're tough. You can see already there's like so many moving parts to them, and that makes it much more difficult to analyze. It's not like, oh, I own a mutual fund and here's the cost. You know what I mean? Like, this is one of the reasons that I worry about these products, because the complexity of them makes analyzing them very hard. It also kind of like makes you a little bit less, I think for most of us, less comfortable analyzing it because there are those moving parts. I think that's one of the things that I think is very important. If you would like to join us on the program, just like Karen, all you need to do is get onto our website. It's jillonmoney.com, jillonmoney.com. And while you're there, you can subscribe to both of our podcasts. One is called Jill on Money, and the other is called Money Watch. You can get them on Amazon and Apple, Google, Spotify, Odyssey, wherever you get your favorite podcasts, or just go to our website and we have the links right there. It's very easy to do. While you're on the website, since podcasts are free, why not sign up for the free weekly newsletter? Comes out every single Friday. Mark does such a great job compiling interesting stuff. Okay, Jill on Money. We'll be right back. You're back. It's Jill on Money. Before we close out the hour, let's do an email from Christine. Obviously, this came in right after Silicon Valley Bank went kaput. And the question is, if someone has in excess of $250,000 in a savings account, should one open another account in the same bank or put that excess amount into another institution? Well, the rules around FDIC insurance are kind of interesting, Christine. So the first thing you need to know is that the $250,000 limit is not about necessarily the account, but it's about the titling of that account. So if that account is just in your name, so you have a savings account with $250,000, you can't just say, oh, I'm going to put another $250,000 into a checking account. So the safest thing that you can do as that individual, the titling, again, the key here, is to go to another institution. The great news is that it's a lot easier to do this than it was in the past. You can go to depositaccounts.com. You can go to bankrate.com. And those aggregation sites are going to give you the best rates for various products. It's so easy to do. And frankly, the failure of these banks is probably a good wake-up call as well, just to understand that you should only be doing business with an FDIC-insured institution, or if it's a credit union, there's also credit union insurance. And it's good to make sure that you keep those amounts under $250,000, even though the government did eventually come in and kind of come to the rescue and backstop people who had more than $250,000. If you're a business or a nonprofit and you've got more than $250,000, I think that's a little bit more of a hurdle. Of course, you can open a brokerage account and buy treasuries yourself. You can buy T-bills. There's a lot of ways to have cash management options that are more than just a checking or a savings account. So I hope, Christine, that this makes sense. If you have follow-up questions, don't hesitate to reach out to us. It's the Jill on Money Show, and we have a whole nother hour of fun. We'll be right back.
It's the weekend, and that can only mean one thing. You're listening to Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome back. It's hour number 2 of the Jill on Money Show. We're so happy you're with us. If you've got a financial question, we'd love to hear from you. You can just go to our website, jillonmoney.com, click the Contact Us button, and we'll be sure to get you on the air. Now, this hour, we have a return visitor to the program. Mark Miller, he has a new book out, and it is called Retirement Reboot: Common Sense Financial Strategies for Getting Back on Track. If you think that you knew the ins and outs of Social Security and Medicare, oh, no. Mark has it all. Every time I talk to him, he opens my eyes to a new issue, and I'm so grateful for that. So here is the first part of our conversation with Mark Miller. Welcome back to the show. How are you?
Jill, great to be with you. Thank you.
Mark, you are very busy, man. You do a lot of writing, you do a lot of research, but your passion has been for a while, yes, retirement. Now, why is that? Why are you so flummoxed by the world of retirement, or not even flummoxed? Why are you so enchanted by it?
Well, I got interested in 15 years ago when I worked on a magazine startup focused in this area that, as many magazines do, it only lasted a couple of years. But I caught the bug. I got really interested in this topic for a number of reasons. One is that, looking at actually writing the business plan to launch the magazine, I was like, wow, this is going to be the demographic story of the United States for the next several decades, which is aging. And it seemed to me there were so many important topics within that, in terms of the way that people transition into retirement, both from a kind of a career standpoint and then financially, of course, and the health issues and housing. So it touches on so many topics that really interest me as a journalist. And as I dug into it more, I became really passionate about, as I realized that so many people we're not prepared for retirement, certainly emotionally, but very specifically financially. There's just lots of reasons to worry about the gaps that many Americans are facing in their ability to maintain their standard of living. And that's what ultimately led me to do the new book, which was to try to say, is there a way to do a personal finance book that's for people who don't normally read personal finance books, namely people who are not investors?
Yeah, and people who really need it but don't necessarily think it's for them. So, what is it about our system here in the United States that makes the idea of planning for retirement so difficult for, say, people in the middle to the lower end of the income scale?
Well, I think two things. One is that we don't really have a retirement system. We have sort of a patchwork of different systems that do and do not talk to one another very well. And there's a bunch of reasons for that. And then the second reason is, as I say in the book, I think complexity is the enemy. It's like people look at these complex challenges and they just kind of zone out. It's the deer in the headlight phenomenon. I think there's a lot of evidence from psychology and behavioral economics telling us that a lot of people just freeze when they're confronted with lots and lots of choices. And like my favorite example of this in terms of retirement, the retirement space has to be Medicare. People talk about Social Security claiming decisions as being complex. And yeah, there's some things there that we can talk about if you like. But Medicare is become unbelievably complicated, and I think unnecessarily so. We've had this sort of stealth privatization of Medicare over the last 2 decades. There was never any up or down vote in Congress to say, shall we privatize Medicare? But that is, in fact, what we've done with the advent of things like Medicare Advantage, which is a marketplace-driven platform, and the same for the Part D prescription drug program. So we put the burden on consumers to figure out best fit coverage to make these complicated decisions about, do you want to be in traditional Medicare versus Medicare Advantage? And then we say, oh, and by the way, you should be rechecking these decisions once every year during the fall enrollment season, which nobody does. Very few people do. So there's lots of
or if you're
complexity.
My mother, you just call up your kid and you say, what do I do?
And Jill does it. Jill rechecks the coverage every year. So
it's hard though, because those plans do change. You're absolutely right. And I remember when my parents first went on Medicare. So I was still a financial planner, I guess, at the time, like 20 years ago or whatever. And it was much simpler. It has gotten more complex. The whole idea also of the IRMA rule, right? This kind of blew my mind. And I know it's more for wealthier people, but then all of a sudden people who aren't exactly wealthy get caught in this trap of IRMA, this income related monthly adjustment amount, which is basically like you're making too much money. You got to put more money towards Medicare. I think this is a shocking factoid for people who may not realize, like, oh, like we just got a call recently on the podcast. I sold my company and I just it blew up my whole IRMA calculation.
Two things about IRMA. One is that more people are falling into it because they file for Medicare, but they might still be working.
Right.
So, if you still have reasonable wage income, you're gonna pay a bit more. Like I do. Like I'm on Medicare, but I still work. So
what? You cannot possibly be 65 years old. That's the most shocking thing you've said so far today.
No, you're right. I'm not 65. I'm 68.
Look damn good. Look damn good, man.
So where were we here? Yeah. So that's the thing with IRMA, is that a lot of people are getting caught in that trap. But, the good news is that you're working longer, so you're doing yourself a lot of favors with that. So the fact that you're paying a little bit more for Medicare, I don't think is the biggest deal. But yes, people do get caught with that.
But what do most people do when it comes time to sign up for Medicare? Like, has there been a cottage industry of people and advisors who crop up and help people out? Are those ripoffs? Is there a way? Are there fantastic resources that help people walk through, like I would call it like the equivalent maybe to like these insurance aggregation sites? Is there anything out there that's helpful?
What we see in the survey information is that people are turning to friends and family for advice. They're turning to insurance brokers. And insurance brokers, that's okay in the sense that brokers tend to be pretty knowledgeable about the insurance products that they sell. But the problem there is that no insurance broker is going to be able to represent the entire range of options that's available in your region. Typically, like in Medicare Advantage, you might be selecting among 25 plus plans in your market. Same could be true for Part D Medicare. So the place I try to point people to is what's called the State Health Insurance Assistance Program, which goes by the acronym SHIP. And those are...
Which is an unfortunate acronym if you say it quickly.
Yeah, exactly. So that is a program that's jointly funded by states and the federal government, generally staffed by trained volunteer counselors. So it's unbiased, objective, generally quite knowledgeable advice that's available to help people with these choices.
We'll get back to our interview with Mark Miller in just a minute. If you've got a financial question, whether it's about retirement or anything else, you can reach us by going to our website, jillonmoney.com. Click the Contact Us button. So easy. We will be right back.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
You're back. It's Jill on Money, and we are going to get back to our conversation with Mark Miller. Mark's new book is called Retirement Reboot. It is such a great dive into this thorny and often confusing topic, and that's why I love having an expert like Mark with us. Let's get back to our conversation because we were talking about Medicare, and God, don't we all need help with that program?
There's two big messages in my Medicare chapter that I want to leave people with, if nothing else. One is watch out for late enrollment penalties. You were talking about IRMA, but the bigger pitfall is if you don't sign up on time, you're stuck with these rather onerous penalties that get tacked onto your Part B premium. And those are lifetime penalties. So you really have to navigate the enrollment timing. Generally speaking, you're required to sign up in a window around your 65th birthday, or you pay the penalties. But the big caveat is if you're still working, if you're still actively employed, then you can stay on an employer's policy and you won't have these penalties. But so there's a lot of ins and outs on that, and I get into in the chapter, but that's message one. And the other big message that I want people to get is when you first sign up, you might be making a decision that becomes irrevocable. And that decision is deciding to join a Medicare Advantage plan rather than traditional Medicare. And the reason it can be irrevocable is that when you first sign up for Medicare Part B, you have an opportunity to buy a Medigap supplemental policy, which is what you use in traditional Medicare to plug the gaps. And there's a guaranteed issue window there, meaning insurers are required to sell you a policy during that window without respect to any pre-existing condition you might have, and they have to sell you a policy at the best prevailing price. After that window closes, they're not required to sell you anything. And so let's say a couple years, you join Medicare Advantage, you don't buy a Medigap because they're not used in Medicare Advantage. 2 years later, you're unsatisfied and want to go into traditional Medicare. Well, you can make that switch during the fall enrollment period, but you may or may not be able to obtain a Medigap policy, which from a practical perspective means you're kind of locked out of traditional Medicare because nobody should be in traditional Medicare without a Medigap. So those are my two big things. People really need to pay careful attention to those late enrollment rules and also really think through carefully this choice of traditional versus Medicare Advantage. And I'm a big fan of traditional Medicare. I say to people, if you can at all swing the somewhat higher upfront costs in terms of premiums, you are getting what I regard as to be the gold standard of health insurance in the United States, which is traditional Medicare.
We often will get a ton of listeners who are sort of like, what's the deal with long-term care insurance? Because for some of them, they purchased long-term care insurance and then they got, snagged in that terrible spiral where your premiums go up dramatically. Is it really worth it? Who really needs it? And I'm just wondering if you have any view on long-term care insurance, the use of it, and whether we're making too much out of it.
So I do have a chapter on this in the book. And I think the long-term care insurance is probably the most broken component of these retirement systems that we were talking about earlier. The long-term care insurance business really is targeted for middle-class households. Affluent households probably don't really need it because they can self-insure. And low-income households don't need it because they're covered by Medicaid. Middle-class households it's arguably the group that would benefit the most from this kind of insurance. But the costs are high. It can cost now, I don't know, $4,000 to $5,000 a year for a couple. If you have inflation protection built in there, which you should have if you're going to have a policy. And then, as you mentioned, the insurance companies have been just boosting these premiums by double-digit rates, and that make it even harder for policyholders to hang on. So you wind up buying a policy, paying into it for a number of years, and then you have to either drop out of it or reduce your coverage in order to handle the cost. So it's not a well-functioning component of retirement, risk protection. It's been declining for years. The number of new policies being sold has been falling.
When you think about that middle, I always call it like the donut hole of long-term care. Like you got $2 million, you're going to self-insure.
Right.
You got less than, I don't know, 300,000-400,000. You'll probably spend some money down. That will stink, but you'll qualify for Medicaid. Is that middle there? Is that like an asset level middle?
I think you have to think about it from an asset standpoint, since you're looking at taking a chunk of your savings and devoting it, or at least tagging it and saying this money is available if I should need this, right? So, that could be several $100,000. Now, you look at the retirement savings landscape, and this is another key thing that motivated me to write the book. You break that out, and sort of it's really the top 20% or so of households that have significant retirement savings. The median for a household age 55 to 65 is about $140,000, but the median figure kind of masks what's really going on there, which is all the accumulation is in the top 20 or 25%. So those are the households that have the kind of assets that could protect them from this. I think for the middle class households, what I point to, I'm not a big fan of long-term care insurance because I think it's so dysfunctional.
Yeah, I agree.
I think that this risk, it's the kind of thing where, maybe 25% of households are going to have a really big need financially. Of course, nobody knows whether they'll be in that 25% or not. A lot of the care is, of course, and some people get care provided by a family member. That's another way of quote unquote funding a long-term care need, but it's problematic and, it's not something everybody can rely on. I tell people that this question is one of the best reasons I can think of to delay a Social Security claim. I think it's typically women outlive men. They're more likely to incur a long-term care need for that reason. They're also more likely to be living on their own. And so an optimized Social Security benefit can be really helpful there. And it's, of course, the benefit is adjusted for inflation every year, as we just were reminded by this monster 8.7% cost of living adjustment for 2023. So, having a maximized Social Security benefit can be really beneficial. I'm not a big annuity person, but I do think there's one category of annuity that could be appropriate to help mitigate long-term care risk. And that's these deferred income annuities, where you purchase one in your 60s, let's say, at a greatly reduced rate with the expectation that nothing begins paying until maybe age 80 or 85. That's the kind of thing that if you then have a long-term care need, a deferred income annuity might be a helpful way to meet those costs. That's a hard product to sell for behavioral economic reasons, right?
Yeah.
It's like, I might never see a dime of it. Well, the same is true with a long-term care insurance policy. It might or might not That's not a good argument for not buying insurance.
No, but it's like they're complex. I think the problem when you get to the annuity part is that it becomes a complex product with a long-term care add-on, which always is like a little freaky, right?
But that's a little different. That's the hybrid life insurance policy.
Right.
Number one, to afford it, you have to be wealthy. So what's the point? Now just self-insure. I think those hybrid life insurance policies are really a black box. They're hard to really understand. Mm-hmm. And I'm skeptical about them. But they're aimed at addressing that point that you just made. Well, at least I know I'll get a life insurance payout. But I don't know. I just think these hybrid products, approach them with some skepticism because it's hard to really pull apart the pieces and know what you're buying.
But also, I think there is something to be said for like understanding that it's like, someone's pointed this out to me recently. It's like you always hear the horror story, but the real statistical information on which you can base a lot of your decisions is not that you're going to plow through $800,000 of your money. Of course, there are places where that happens. There are instances and families where that happens. That is the way outside possibility and probability for most people, right? So that's the other part of it. Like, I don't want to overstate it. We'll be back with Mark Miller in just a minute. If you'd like to ask us about Social Security or Medicare, what options are out there, just hop onto our website, JillOnMoney.com, click the Contact Us button, and we'll get your note.
Back to Jill on Money, where Jill Schlesinger helps you take the mystery out of your finances.
You're back. It's Jill on Money, the program that attempts to take the mystery out of your financial life. Okay, now let's get back to our conversation with Mark Miller. All right, let's move to Social Security, which ostensibly it should be an easier conversation to have because you no longer can do a lot of those funky claiming strategies that you used to do, but it's still it's crazy. It is really hard to manage this. So the one thing that we pound home always is like, please don't take Social Security early. But I presume that you also are aware and you talk about the fact that, there are some people, they don't have a choice. That is it. They're 62 and they don't have enough money and they do have to start collecting. What percentage of individuals actually collect Social Security at 62?
All but about 20% have claimed by their full retirement age, which these days is about 66. So a key fact here is that not enough people are delaying past that point. More people should be delaying past full retirement age to maximize the benefit. But I do know that number has been falling. In other words, more people are waiting at least till, 63, 64. So that's a positive trend, but we'd like to see more people delaying further. And I agree with you. I think even though as a general point, more people should be delaying, there can be good reasons for claiming at 62. Yeah. If you're in poor health, you absolutely need the income. For married couples, it might make sense for the lower earning spouse to claim a little earlier to start flowing some income into the household while the other one delays. The other point worth making about delay is that you have to fund your delay in the sense that you need income to live on if you're retired while you delay. For married couples especially, it's rare that both spouses retire at the same time. So maybe one spouse is continuing to work. That provides the income to live on, or at least partially live on while you delay. So there's lots of strategies that are available for people to delay. Thinking about Social Security as longevity insurance in the way we were just touching on with certainly with long-term care, but even more generally, just getting a guaranteed income source should you live well into your 90s that's inflation protected, underscore boldface, right? Yeah. Inflation protected. Show me where else you're going to get that. You can't.
You can't. And you know what? It was a great lesson when we got those COLA numbers. Mm-hmm. And I always laugh about this because I say, I heard from people, they're like, well, I didn't get a big enough inflation adjustment to manage inflation last year, 2022. And I'm like, well, the flip side is you're going to get a bigger one in 23 and they're not going to reduce it when the inflation rate starts to go down.
Right.
So,
it all comes out. That all comes out in the wash.
Totally.
And all this debating about, well, is the current formula for the COLA the right one? And you can go back and forth on that, and there might be some adjustments. But hey, the basic fact is you get an inflation adjustment that more or less is going to keep people even with inflation. We didn't always have it. A lot of people don't realize this, that we've only had the automatic cost of living adjustment since 1975. And before that, before people take it for granted now, but it was one of the most remarkable improvements. Hundreds of improvements have been made to Social Security over the decades, but this is a big one. And before that, it was just kind of at the discretion of Congress to award cost of living increases, and they would sort of do it in fits and starts, and sometimes in big numbers, sometimes nothing at all. So to your point about the lag effect, you might have, during when we had periods of very high inflation, people might be waiting several years for any kind of cost of living adjustment because Congress didn't get around to it for whatever reason. So changing it to this automatic formula is huge.
So, Mark, there is also this kind of weird moment in time here where we see a lot of people experiencing a huge swell in equity in their homes. And, pandemic acceleration and all that being said, but that may be someone's largest asset. And I'm wondering if your opinion around reverse mortgages has changed, different rate environment, different amount of equity in homes. What's your opinion about the reverse mortgage?
So I do a chapter in the book about home equity more broadly that includes reverses. And the reason I did that is that, as you say, it may be the largest asset particularly for middle class households. So you have to at least ask the question, is it appropriate to tap your home equity in retirement? And there's a number of ways of doing it. You can start with the idea of downsizing, moving into something smaller, pocketing the difference, moving to a less expensive location, all those things. And I go through some detailed illustrations of what those options look like. Now, though, the problem with those options is that they are not as straightforward as selling a more of a financial asset, a liquid asset, because here it's all wrapped up in your lifestyle choices, where you choose to live, proximity to family and friends, the community you're in, and so on. And so, we know that a lot of people say they aim to age in place. And so if that literally means staying in your house, that's where the reverse mortgage can come into play. Now, not a big fan of reverse mortgages. I think, again, they're an example of a very complex product, and that people have to jump through hoops to deal with properly. But the good news about reverses is that over the last 10 years or so, they have gotten to be a safer, better product due to improvements in the way that they're regulated, at least the federal program, the Home Equity Conversion Mortgage, or HECM for short, which is those are the federally insured reverse loans that's what you want to look at. They generally nowadays are lines of credit, which is also better. You're not drawing down in big lump sums. The thing to look out for with them is that the fees can be pretty high, but they have gotten to be a safer product now. So I do include a section of that chapter walking through in quite a bit of detail what those products are, how to navigate through them, and how to shop for one, and so on. But with the caveat that it's not my favorite option in the toolbox.
Mark, where else can people find all of your great information?
Thank you. Well, on my website, retirementrevised.com, you'll find, number one, a link to sign up for my free newsletter that I publish sort of 2 or 3 times a month generally, which in the newsletter carries links to everything I'm doing. And the other thing I'll mention is that I did a podcast series about key themes of the book that are all published now, and there's links to that also on the website. I sort of had guests on talking about some of these key themes like Medicare and Social Security and retirement planning to just sort of illuminate some of these ideas that are in the book. So people may find that podcast series of interest. But I would start with the website and the newsletter.
Well, thanks again to Mark Miller. His new book is called Retirement Reboot: Common Sense Financial Strategies for Getting Back on Track. When we return, we're getting back to your questions. It's Jill on Money.
Welcome back to Jill on Money, where Jill Schlesinger takes the mystery out of your finances.
You're back. It's Jill on Money, and it is TikTok time if you're thinking about your tax situation. We are just weeks away from the tax filing deadline, which is April 18th this year. So if that is something that is front of mind for you, you may be interested in subscribing to our new service. It's called Jill on Money Live. This is a service that will allow you to have access to quarterly live webinars and more special content. We're working on that right now. The first webinar is coming up on March 30th. It is with the honorable and wonderful Ed Slott. I like to call him like the first fan of the Roth IRA, but he is so much more than that. He is an IRA expert. He is a CPA, and he is one of the most favorite guests that come on the program. But if you want to join him live and ask questions to him directly, you've got to actually subscribe to Jill on Money Live. Check it out. All the information is on the website. All right, let's do some emails, Mark. We've got a question. Oh, this is good. Very timely, because we just had a news story out as we're recording this about the inability for the United States to pay its bills come this summer because the ding-dongs in Congress haven't lifted the debt ceiling yet. And so Saul says, if for some reason the U.S. government defaults on its debt, will I lose money in my T-bills? Is there a way for me to be protected? I think, Saul, the big question is not so much whether you're going to lose money on those T-bills, because if you hold them to maturity, you're going to get your money back. They're not going to default on every single outstanding debt. I think the bigger question is really going to be, what will the damage be in the markets as we rapidly approach that deadline? So I don't think we're going to go into a full-fledged default. That would be somewhat catastrophic for the economy. But as we get closer, I do think that there is a high likelihood that the volatility in markets is going to increase. I don't think that they're going to probably let it go to that. But you know what? There are some wingnuts in that Congress. So I wouldn't be surprised, but I wouldn't be worried that you're going to lose your money. All right, Amy, in the subject is how to do it myself. Hi, Jill and Mark. Thanks for the amazing podcast. You are welcome, Amy. When my ex and I separated a couple of years ago, I bought out his half of my house. Okay, I love where I live, but shouldering that whole mortgage and fixing it up is turning out to be a stretch. I have a few $5,000 to $10,000 projects and, oh my gosh, $150,000 remodel that would improve the quality of life. Can you help me think through how to balance house expenses versus other spending versus retirement savings? Okay, more context. Amy is 39, kids 5 and 7. I do not expect to retire early. I intend to live into my hundreds. That's quite an intention. Let's put our intentions out there, Amy. I really hope I don't live into my hundreds, Mark. 88, I think, is the right age for me. 88's good. It's very Chinese, the 8s, right?
You're all about the number 8.
I totally am. Okay. Amy makes $180,000 a year. She spends $10,000 a month. She maxes out the 401k. So this is good numbers, right? Oh, here's the deal. House is worth $850,000. The mortgage is $500,000. It is a 3 1/8, 3.125%. Okay. I have $13,000 in checking, $50,000 high yield savings emergency fund, retirement $250 traditional, $100 in Roth. Great. Oh, I was so excited. She said she has a pension from an old job, and I read it incorrectly. She said, I have a pension from an old job, $8,000 a year, and I thought it was $8,000 a month. Darn it. Okay. She gets $8,000 a year when she's 65. Kids, 529 is $40,000. Who knows? Maybe I'll find someone special to share my mortgage again. Interested in your take. I don't understand where the $150,000 for the remodel is coming from. Do you, Mark? I mean, is she asking? First of all, you're not going to refi. You have a 3 1/8 mortgage. Could you not do this remodel? Can you live with what you have and just do a few of the $5,000 to $10,000 projects? I don't see a $150,000 remodel in her future. What do you think, Mark?
Unless that money is sitting somewhere and she didn't mention it. I don't know where she's coming up with the cash.
I mean, here's another thing. If you love your house, okay, and I don't know about improving the quality of life. There's 3 of you in this house. They're 5 and 7. How much quality of life do they care about? Maybe they share a room. Maybe there's only one bathroom. I don't know. I need more information. Here's what I think from what you've written. I do not think that you should remodel this house and spend $150,000. I don't think you should blow through your emergency reserve. I guess there's a possibility. I don't know. Maybe not. I was going to say to sell. But then if you sell, you have that nice low mortgage rate.
Maybe she's thinking of doing a line of credit.
Maybe, but a line of credit is expensive right now. You know, I don't know. Amy, can you give us a holler back? If you want to stay in the house, you do a few of the projects to fix it up. You save along the way. After you have put your money into your retirement account and spend your $10,000 a month, there's not much left over, you know? 180, she makes 180. She puts money into the 401k. She spends $10,000 a month. She pays taxes. I bet there's not that much more left over. I need more information. I want to know who's shouldering the burden on the kids. Is there any sort of sharing of expenses with the ex? I feel like we need more creativity here. So Amy, give us a holler back. All right, one more segment left. It's the Jill on Money Show. We'll be right back. You're back. It's Jill on Money. Before we finish the program, let's do an email. This is from Karen, who says, my daughter just turned 18 and she's asked for our help to develop a savings and investment plan. My God, she's 18. That's amazing. She has a part-time job. She earns about $400 a month. Additionally, she has about $10,000 in a savings account. She starts college in the fall, and we will be able to help her pay for it, so she shouldn't need any student loans for her undergraduate, her bachelor's degree. Our thoughts are an investment account where we would look at an ETF, an exchange-traded fund, and maybe some amount for her to experiment with investing. Or maybe a Roth IRA to get her started. Or maybe an I-bond that she could access after college to help pay for grad school and our other costs from starting out in the world. What advice would you give her? Well, I think I'm with you in that I think that we want to give her a way to kind of explore, but give her a base also. So maybe having an exchange-traded fund, a stock index fund, and maybe even a teeny tiny bit that was in a bond fund, just so she could see how those assets move. I love the idea of her opening both a Roth and an individual account. With the Roth, she's probably not going to be able to do the max of $6,500. She would be limited to 100% of her earnings, or the lesser of that, or the $6,500. So it'll be less. But I like her doing both. I like her using some base of sort of an asset allocation of some stocks, maybe a tiny bit of bonds. And maybe I would buy an I-bond just to give her that experience of what a guaranteed bond looks like. And you also get to explain what inflation's all about. So maybe a little bit of everything, a cornucopia of investing experience. Well, that is it. That is the program. Our music is composed by Joel Goodman. Karen Kranick is our web queen. Mark Talercio is our executive producer. Try to do something nice for someone else today. If you have any questions, just go to the website, jillonmoney.com. Thanks for listening. We'll talk to you next week. Change your work, change your wealth, change your life.